Russell, so good to see you. Today, we're going to talk through 76 years of headlines, what market history teaches us about staying invested. From oil embargoes to global pandemics, the S&P 500, of course, has endured decades of uncertainty and come out stronger over time. So I know you're a student of history. Let's break down the data and talk through whether pre- and post-retirees should make any changes to their portfolio. And I want
Great,
to show
let's
you
do
this
it.
chart. Yeah, let's do it. Let's dive right in. Starting here. What stands out to you about how the market responds to global events?
Well, I mean, these sort of logarithmic graphs, show things in a certain way, but obviously the trend is up. And actually, I was just hearing the story of someone the other day who got out of the market in 2008 and never got back in. So, it shows you a couple things. Market timing is impossible. And number two, it does show you that there are some big downturns that you got to protect yourself from.
Right. Of course, I know you build volatility into everyone's portfolio, but I feel like what we hear a lot is stay the course, stay invested. That's often the best advice. But if I am feeling uneasy about how I'm invested, when is the right time to make changes to my portfolio?
Well, really, for folks that are close to or in retirement, what we call sort of the retirement red zone,
Right.
5, 10 years prior to retirement, in retirement, at that point, you get to a point where you really can't have more than, in my opinion, 50% of your money just in the outright stock market. Why? Because we know the stock market can drop in half. It has in 2002, 2008. And if you have all your money in the stock market and it drops in half, well, then you lose half, right? Whereas if you have half your money, you lose a quarter. So you got to control as you get closer to retirement, you're in that red zone or in retirement, you got to control the amount of exposure you have and start looking at, what we call like kind of volatility controlled
Of course.
or protected investments.
And so I know you specialize in helping people in the retirement red zone. For someone then who has a longer time horizon, how is that advice different?
Well, look, if I'm advising, my own kids in their 20s or their peers or folks in their 30s or 40s, if you're saving for a certain thing, like I'm going to do a house renovation in 3 years, well, then you want your risk to be low. But for
Mhm.
those people, they should be like in their 401ks, 100% in the S&P 500. And in fact, I think that the investment industry does them a disservice by putting them in these so-called target date funds.
Right,
So
right.
you happen to speak to your kids, tell them 100% S&P 500, tell them also 100% Roth.
Yes, thank you, Russell. That lesson came too late to me in life. I wish I'd met you 20 years ago, but let's focus back to the people who are in that retirement red zone, because we can't have this conversation without talking about sequence risk. For people who are recently retired or about to retire, a down market presents a very unique challenge. Can you explain sequence risk, please?
Yeah, and you're going to pull up that graph, right,
Yep.
Aaron, that basically shows, we call it sequence risk or sequence of returns risk. In this graph, it shows a situation where the average return is 4%. But depending on when you had the negative returns, and the one on the right is where the negative returns are early in retirement, you can end up in a much worse place than someone where the negative returns are much later in retirement, right? So to me, it's sort of all the same lesson that we've been
Mhm.
talking about here, Aaron, which is that, if you're in your 50s, 60s, 70s, wherever you are, that you really cannot afford big downturns,
Right.
especially early in retirement, because you're just having to dig yourself out of a hole.
Right. So then what is your best advice to help people who are in that retirement red zone avoid sequence risk?
We like having more than, about half of people's assets and what we call safe assets.
Okay.
Safe assets to me are not what Wall Street often says they are, which is bonds. Bonds lose money in inflationary environments. They're losing money this year. They lost money in 2022, the last big inflation. We like things like T-bills. We like things that are principal protected. Those are available in annuity form. They're available in exchange traded fund form, like things that protect you to the downside but give you upside. Those help you with both your long-term growth and they help you maintain sanity during market downturns.
Oh my gosh, absolutely. It all comes back to peace of mind, doesn't it? So, Russell, if somebody would like to sit down with you, create that plan that has the volatility built into it, what's the best way to reach you?
Aaron, either our website, which is hackmanwealth.com, or our 800 number, 866-506-1713.
Great. Russell, thank you.
Thank you.